Welcome to CAP STRAT this week. We are looking forward to the first Fed meeting of 2024. So we're going to dive right in and talk about what the Fed could be looking at and what could be next in terms of monetary policy actions. So, Mike, let's start with some of the data we got last week indicating that what the Fed is doing might be working.
Absolutely, yeah. Last week, we got the advanced estimate of Q4 GDP growth, which we're looking at real GDP year over year in the dark blue line. Put the year over year number, so for calendar 2023, at 3.1%. What a recovery from where we were in December 2022, where arguably the consensus was we were on the brink of a recession.
Right.
So economic growth has defied all expectations in 2023. And as that's been happening, we also received core PCE, the Fed's preferred gauge of inflation, and on a 6-month annualized rate of change basis, that figure has come down from a high of 5.9% in March 2022, which was the month that the Fed started their rate hiking cycle, and is now down to 1.9%, slightly below their stated 2% target. So here we are, inflation running, trend inflation, if you will, running below target, economic growth accelerating, totally defying expectations. Anybody who back here in March 2022 said that the Fed was going to raise the federal funds rate from 0 to 5.25%, 5.5% range, bring down inflation by 4%, and achieve an acceleration in economic growth with no tick up in the unemployment rate, that was the hottest of takes you could have possibly had. We had the view, we're not saying it can't happen, it has just never happened before.
Yeah.
This is the first time.
And you add on to that the fact that Q1 nowcast is still starting to come in at 3%.
Yes.
No indications that economic growth is going to be slowing down.
Mm-hmm.
And we didn't even have to wait for Jackson Hole for them to move the goalposts and potentially increase that inflation target. We're already back below that 2% inflation level.
Yep.
It's pretty incredible. And so, to the question here, did the Fed stick the landing? I mean, they're done, right? Just a nice orderly decline in the federal funds rate and we're good to go.
Well, this, of course, begs the question, if the Fed's data dependent, if all the data they're looking at suggests that, they've defeated inflation without compromising the economy or the labor market, then in theory, the Fed funds rate should be towards the neutral rate. It should be at the neutral rate, which by all estimates, the neutral rate varies throughout time, but that's somewhere in the 2.5% to 3% range seems reasonable. And they're not. They're at 5.25% to 5.5%. And, they're going to meet this week. There's a 0% probability right now baked into market expectations that the Fed hikes this week. Or I'm sorry, that the Fed cuts this week. So
we've all been there before.
Right. We've been there. So, the Fed should be, they're looking at this data, the Fed should be cutting rapidly, which goes back to a point we made coming into 2024, that if the Fed is going to make a policy mistake this year, it will come from leaving rates too high for too long. And when they start cutting rates, those cuts being potentially too little, too late. And we think right now we're potentially at the most vulnerable point in this cycle. I mean, you look at the data and you say, vulnerability? What are you talking about, right? You look at market prices. What are you talking about? But if you look at the Fed funds rate on a real basis, meaning adjusted for inflation, this is arguably the most restrictive they've been.
Yeah. So what we're looking at here, we've got the Fed funds rate in purple, that same 6-month moving rate for core PCE in blue. And, the difference between those is the real federal funds rate, right? And so even though the Fed hasn't done any hikes since late 2023, we're still with this decline in inflation. Monetary policy is at the most restrictive stance it's been since just before the great financial crisis, right?
Scary stuff, right?
Yeah.
The most restrictive since 2007, as measured this way, the real Fed funds rate. And that's why our view is the underlying dynamics of inflation are the reason why they can't cut right now. They can't cut in January. It's the reason why the probability of a March cut is about a coin flip.
Right.
And our view is, based on the Fed speak since the December meeting that the Fed is trying to push that probability of a March cut down towards 0%,
Right.
meaning no move in March either. It's because of those underlying inflation dynamics. So here you have it. Probability of a policy mistake, believe it or not, is actually rising.
Right. Yeah. Yeah, exactly. And you take all of that into account. So making progress on the data side, potential for a policy mistake as high as it's potentially going to be for this cut cycle. And you compare that with what the market is thinking. Right. And so here again, federal funds rate in purple, S&P 500 forward PE ratio in green. And, despite the significant rate hike cycle, this PE ratio largely just continuing to go up and up.
That's right. Right now, the S&P 500 is priced at a little over 22 times earnings expectations over the next 12 months. Forward PE ratio. That is very expensive. You look, aside from coming right out of COVID, that's pretty much the most expensive multiple we have in this entire, going back to 2005 on this chart. And just for comparison's sake, we also have this gray line, the 2021 average, which is where you start to take out some of those COVID abnormalities in the data, was averaging 22.8 times next year's earnings. Very expensive. However, the Fed funds rate in 2021 was 0. So, going back to, all right, it looks like we're so close to the Fed sticking the landing. But believe it or not, the probability of a policy mistake is elevated until they actually start cutting. They're actually very vulnerable. And the market, you could argue, has already priced in the entirety of the rate cutting cycle. The S&P 500 is trading at a multiple. The last time we saw it was when interest rates were at 0.
Right.
And we're clearly not at 0. So the market is priced for perfection, but you have to look under the hood there, right? Within the S&P 500, almost 30% of that index is made up of 7 companies.
Right.
The Magnificent Seven, which I just found out was actually a Western film from the 1960s.
It was, yeah.
I had no idea.
Yep.
Anyway, they're priced at 35 times earnings, meaning the rest of the market actually still has felt a bit of the brunt of this hiking cycle and has not fully priced in an entire immaculate cutting cycle. So there's opportunity there if all goes well, small cap areas of the market, value areas of the market. But by and large, in its entirety, the S&P 500 has already priced in a perfect cutting cycle and no policy mistakes.
And it's perfect cutting cycle is an interesting phrase, right? Because you've got these elevated PEs expecting the Fed to pull it off, so to speak. But to your point of comparing this to a time when interest rates were at 0, the Fed is not calling to get the federal funds rate towards 0 anytime soon. And if that were to be the case, we're talking about a very different economic environment where the Fed is looking to kind of rescue economic growth as opposed to dampen inflation. Another interesting thing I wanted to point out here, you see 2 other rate hike cycles, and this type of movement during a rate hike cycle is not supposed to happen, right? You see rate hike cycle here, PE ratios sideways, rate hike cycle here, PE ratios essentially sideways for the entire time period. This is very unique and being healthily driven by the Magnificent Seven.
Right. The only other time you saw in a rate hiking cycle multiples get this high were at the end of 2017 that's when markets were starting to price in a cut in corporate tax rates. Right. So they were trading at pretty elevated relative to next year's earnings, but we knew those earnings were going to go up.
Yep.
So that's really it. And so obviously you mentioned how do we get, if the market's, more than pricing in a perfect cutting cycle, they're pricing getting back to 0. How does that even happen? I mean, that would be a bad scenario, right? At this point, given where the inflation and the economic growth data are, it would be a shock within the labor market.
Right.
That would be it. And so that's why this week, such a big week, you have the Fed meeting, which, the decision is going to be a snoozer, right? They're not going to do anything. If you really dig into the statement, which of course is what we do because we're nerds, right now, if you look at the statement, they made a slight modification from the November to the December meeting to reduce the hiking bias that's implicit in the statement. They added the word any. Believe it or not, that was significant. It'll be key to watch in the statement at this meeting if they remove the hiking bias and replace it with something more neutral or replace it with a cutting bias. And that can be a few words switched around. The market will run with that and price in 100% chance of a cut in March.
Yep.
If they don't change the statement from December, that's when we think the probability of a March cut will fall pretty sharply back towards zero, and everyone will expect that we just hold until perhaps May, the April-May meeting.
Yep.
But then you also have jobs data on Friday, right? So that's where, at this point, if we're going to see a more rapid cutting cycle, it's probably going to come, something back down to 0%. It would have to come from a big surprise weakness in the labor market, the Fed responding to that, and probably a recession. It would be a hard landing scenario.
Yeah,
so
absolutely. So yeah, to just wrap that up, no expected policy change from the Fed this week. What we view as important to keep an eye on is that statement that comes out and which way they're trying to guide the market for the March meeting, which could be the next time they move.
And the Q&A, of course.
Q&A.
Right.
Yeah. All right, so let's dive into markets. Digesting that economic data, trying to gauge what the Fed could do. Another week of green across the board for equities.
Yep.
Getting excited about a nice economic growth report.
Yeah. A few things going on. One, within the U.S., you saw smaller cap and more value-oriented areas of the market outperform. As we said before, if anything like an immaculate landing gets pulled off, which in our view, the next 5 months is going to be tough, right? That's where there's high probability of a policy mistake. But if that immaculate landing gets pulled off, the smaller cap, more value-oriented areas of the market have catch-up potential.
Right.
So we got a glimpse of that last week in the trading activity because the GDP growth data was so good and the inflation data was so benign. And then if we go overseas, we also saw there was a European Central Bank meeting. Christine Lagarde at Davos pushed back pretty hard on the idea of rate cuts in the first half of this year. And she didn't exactly walk it back, but she definitely moderated her tone. So the market got excited about potentially a first cut from the ECB in April. And then also more stimulus coming from China. Mm-hmm. I know that story is getting old, but it was a little different type of stimulus. Early on, the stimulus was around making sure that houses that have been started and paid for get completed, more just making sure there aren't any blow-ups within the property market and that financial ecosystem. The measures that were enacted last week were much more targeted at supporting markets, which is something we hadn't seen yet. So we did see a bit of a rally in emerging market equities as well. Nothing to get too excited about yet.
Right.
The stimulus coming out of China has still been it appears from the outside, sort of unorganized, piecemeal, and not really what investors are looking for. But we're going to continue to watch that, the type of stimulus going forward and the tone around it, to see if basically China is saying mercy and they feel like they need to re-stimulate markets.
Right.
Yeah.
Yep. Moving over to fixed income, some red on the board here through the week, especially in the longer portion of the yield curve, 30-year down about 0.5%. Is that also trying to digest what the Fed could be doing in terms of this January statement and guiding towards March?
That and the data being stronger than expected growth, a little lower than expected core PCE inflation, that's a steepener.
Yep.
Right? So you see that. You see the shorter end of the yield curve, yields coming down, prices going up. Longer end of the yield curve, prices going down, yields going up. And then credit spreads are already very tight. They haven't really moved much year to date. There isn't a lot of room to run there in terms of spread tightening. Just like the S&P 500 by and large is priced for a perfect cutting cycle, credit spreads are priced for an absolutely perfect cutting cycle. So we wouldn't expect a lot of move there. Probably just get your yield, which is still okay, but spread tightening from here looks tough.
Sure. And then from a market return perspective, wrap up with alternatives. Energy putting a big number up on the board last week, up over 4%. Geopolitical conflict continuing to push oil prices higher?
Correct. I mean, the Houthi rebels in the Red Sea up to this point had sort of spared tankers, carrying oil and gas products, especially if they had any affiliation with Russia and China. But they did hit a Russian tanker, is what had recently been reported. And so that definitely increased geopolitical conflict. So we're looking at the commodities market as sort of a real-time gauge, as potential for escalation in the region. Yep. And that's saying perhaps the potential of escalation increased last week.
Gotcha. Yeah. All right. So switching gears, getting into the investment framework, a couple of quick hitters on those 4 pillars of the economic framework. Starting with economic growth, we talked about the strong preliminary report last week, nowcast still at 3% for Q1. Any updates on our economic growth projections?
Yeah, you see that reflected in the data. No, it's sort of subtle, but the endpoint of our forecast is slightly higher, up to 1% real GDP growth for calendar 2024. It was previously 0.85, somewhere around there. So taking that into account.
Awesome. And on the inflation front, inflation continuing to come down below target on a 6-month moving pace for PCE. Here we're looking at CPI and continuing to show a trend back, towards more normal levels of inflation.
Correct. Yep.
Liquidity certainly been a topic we've been hitting on pretty regularly here. Updated our liquidity forecast for some expectations for the balance sheet runoff. Do you want to hit on those?
Yeah, so as we get towards the back half of the year, probably coinciding when we think the first rate cut will come, which is either at the June or July meeting, we're likely to see a taper in the pace of the balance sheet runoff by the Fed. And so that's reflected in our forecast here. So rate cuts in the back half of the year combined with slowing the pace of the runoff and then ending the runoff by the end of the year. And so that's reflected, that's that increase in liquidity. The other thing that we did is right now, the monthly cap for mortgage-backed securities rolling off the balance sheet is $35 billion. But if you look at actual data, due to a lack of maturities on the Fed's balance sheet, the Fed has really been rolling off about half of that per month. And we expect that to continue. One of the big reasons why that's happening is there are just fewer maturities than expected because mortgages aren't getting prepaid as quickly as they otherwise would because mortgage rates are so high. Your 2 prepayment types that push prepayments are a refi, which who would refi, or selling your house and buying a new house, and there still isn't a lot of activity. So we've adjusted our forecast for a slower pace of MBS runoff as well, just due to market dynamics. And so you also see that has slight upward pressure on liquidity in the back half of the year. So once again, this is setting up for, first half of the year, probability of a policy mistake is elevated. The labor market is definitely the area to be watching, and you don't want to get too complacent because the economic growth data is strong. I mean, if you look at unrevised economic growth data heading into 2008 recession, it was running at 4% right before the recession, right? So you don't want to get complacent. But as we get to the back half of the year, if it looks like the Fed is cutting and the labor market data holds up, then liquidity is pretty supportive of those areas of the equity market that have broadly been left behind over the past 2 years, like small caps, value equities, and so on and so forth.
Makes sense. We'll wrap up with our recession signal. It continues to be inactive. You talked about earlier, credit spreads remain very tight, even outside of yellow territory there. The mismatch in the labor market, initial jobless claims versus continuing jobless claims, some research coming out about how dependable initial jobless claims numbers can be in this kind of post-COVID labor market environment.
Right.
Anything you want to hit on with regards to that indicator?
Yeah, the idea is take-up rates are very low. They're almost at all-time lows. So if you're counting on initial jobless claims to capture folks that have recently been laid off, it might not be as good of an indicator as it was in past cycles because the benefits haven't really kept pace with inflation, and a lot of folks just aren't eligible. Eligibility requirements have changed since COVID. We conduct that research on our own. We can recreate all of that analysis. We take a look at it. In our view, it doesn't make a difference in our signal. Our signal is about the rate of change.
Right.
And regardless if jobless claims are suppressed in this cycle or not, the rate of change is what we're looking for to show that we've sort of achieved recession velocity, right? And so that we still feel good about our labor market signal as jobless claims being an indicator, but that's definitely something we're watching, take-up rates. And then there's so much labor market data that's pointing to different things right now that it's going to be really interesting to watch. I mean, if you look at employment flows from unemployed to employed, those flows have tailed off quite significantly just in the past few months, which that type of activity generally coincides with a hiring freeze and a recession. So we're definitely watching that. And then the strongest area of the labor market was the services side. Same thing with the economy.
Yep.
ISM, services PMI, the labor market portion absolutely fell off a cliff last month. And so, we're looking at the labor market data, the JOLTS data, and then that ISM services and manufacturing labor, just to put it all together. Right now, not active, but as just reiterating that point, for the first half of the year, probability of a policy mistake elevated. Where are you going to see that mistake turn up? The labor market.
Right.
So it'll be top of mind, continue to be top of mind for us.
Yep. Gotcha. So yeah, a lot to look forward to this week and digest moving forward. That'll do it for us for this version of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.